Good afternoon. This is Tom Porcelli from PGIM Fixed Income, and I just wanted to give a quick review of the FOMC meeting, which ended about an hour ago. So look, I think Powell, Powell was consistent. I think he was very consistent with his recent speech, which was 10 days ago, and I would even say he's been pretty consistent even prior to that. Even going back to sort of the last FOMC presser. So what does that consistency look like? I think he's really trying to drive home that they really want to be in wait and see mode. They recognize that policy has come a really long way, that you're into restrictive territory. He recognizes fully that he doesn't know exactly how restrictive policy is. He recognizes that financial conditions have tightened. And so in the context of this, and in the context of not totally knowing the degree of tightness that's now in the market on the back of nearly 550 basis points of hikes that they put in place, they want to use, and he used this specific word at his speech from about 10 days ago. They want to sort of look with their eyes and see how the backdrop evolves. I have a lot of sympathy for that. That just strikes me as being prudent at this juncture. If I think about sort of what's to come, because, here we are, just finished this November meeting. We obviously have a December meeting coming up. I think that the hurdle is incredibly high for the Fed to hike from here. This has been our longstanding call, that the last hike was the last one. And so we see very limited scope, short of, data coming in, like incredibly strong, even relative to what we've seen recently. We see very limited scope for the Fed to hike rates from here. We think what will wind up happening is we are starting to see some softening of the data that's very consistent with our baseline view. Our baseline view, of course, is something we call weak inflation, which is effectively sort of below trend growth with inflation that remains north of target. The data are coming in very consistent with this idea of a softening in economic activity, to the point where we think that the Fed will be able to cut rates in the coming year. We're looking for about 50 to 75 basis points worth of cuts. We would call this sort of a modest adjustment, just on the back of a very aggressive hiking cycle. And I think what's going to wind up happening is that's how the narrative is going to evolve for the Fed. They're going to continue to say we're leaving the door open. We want inflation to get back down to as close to target as possible. But I think all the while they're saying that, I think what's going to wind up happening is the data will soften up enough for them to start the process of cutting, which again we think is into next year. So they'll continue to toe the line of we reserve the right to do more. But at the end of the day, we think the next policy action will be cuts in the coming year.